afternoon. This is Lance Bryce with Thrive Mortgage. Today is February the 24th, Friday. Hope you're doing well. Y'all, we are seeing interest rates creeping back up towards 7% once again. We had hoped, fall of last year that we had put the sevens behind us when we hit those benchmarks that we had not seen in many, many years. And we're retesting some of those again now, potentially. Mortgage News Daily tracking poll of a 30-year fixed conforming has us at 6.88% today. So we're just an eighth of a point away from the sevens once again. We were at 6.8% in that poll last week. We were at 6.21% in that survey 30 days ago. So we have seen interest rates move nearly 3/4 of a point over the last 30 days. And inflation is the cause, y'all. We are seeing higher than expected numbers reflected in all of the recent reporting, starting with that non-farm payroll report that came out 3 weeks ago. Now, let's talk about that report a bit, because there were a number of issues with that report that hadn't been previously counted in other reports. There were very large seasonal adjustments made to that report. If you pull those seasonal adjustments out, that report was frankly more closely in line with expectations. Reason that that's important is that report comes around again on the 10th of March. That's really probably our next opportunity to see the markets kind of take a longer view at employment and see where we truly are. There are a lot of folks out there talking about that report from 3 weeks ago being politically influenced, as it was just prior to the State of the Union address, and it certainly gave the administration some numbers to brag about in that speech. It's going to be interesting to see how those numbers are revised with the upcoming non-farm payroll report. Additionally, we've got the Consumer Price Index on the 14th of March. Those two reports together, being 4 days apart, frankly have the biggest opportunity for us to see some movement in interest rates and get a clearer picture of whether we are starting a new trend upward or whether these are outliers and blips, and that we're going to resume, hopefully, that reduction in inflation that we had seen for the numerous months leading into the last 3 weeks or so. If these recent reports prove to be outliers, y'all, then we'll see the bond market quickly adjust, and we will see prices start normalizing back to where they were 30 days ago, if those future reports substantiate the prior trend of inflation easing. It's a bit of a tongue twister, but that's kind of the situation that we're in, y'all. There's no way to really soundbite this into a really quick headline other than to say, we got to see where the news takes us over the next 3 to 4 weeks. One of the things that is pressuring potentially rates a bit lower is we are seeing yields on the 10-year Treasury at 3.95%. Haven't been that high in quite a while. And if the bond market traders are speculating that interest rates are going to be significantly lower at the end of this year, which most of them are, maybe a good time for long-term investors to dive in and grab some of these yields that are being offered on 10-year Treasuries. And that additional demand for the current pricing will push prices still higher. Yields move inverse to that, so we may see a little bit of a dip just based on folks wading deeper into buying some of these fixed income securities based on the current yields being higher than where we think they'll be 6-8 months from now. So that's out there as a possibility that will help us some, as is the future reporting on numbers that hopefully will be less politically influenced, frankly, than the last reporting may have been. And we'll see where that takes us. In any event, I'm going to keep an eye on it for y'all. I will report this out as soon as we have good numbers for next week. Have the blessed week. Stay safe. We will talk to you soon.